So let's have a look at adjusted payback then as a means of dealing with risk and uncertainty. And it's fairly straightforward because everything really that applied to payback applies to adjusted payback. But just to remind you, here's a calculation then. So in year 0 you pay out 100, in year 1 you get 70 back, in year 2 140, and in year 3 80 back. Now in simple payback, all you would do is you'd say, right, well when is this actually paid back? So doing the calculation then, 100, but because they're different figures, we're going to use the cumulative way of doing it. Then 70 comes in, which means we're still negative 30, hasn't paid back yet. And then in year 2, we get 140, so obviously that 30 will be paid back in year 2. So it will be 1 year and so many months. But how many months? Well, the negative 30, just divide it by 140, that gets you to 0.21. Don't worry about the negatives. 0.21 times it by 12 to get to the number of months. It gets paid back 2.5 months through the year 2. So the payback period using simple payback would be 1 year, 2.5 months. Now, what we need to do here though is adjust this to take into account risk, to add some risk into this. So to add some risk into it, what we do is we adjust the cash flows. We create a discount rate that will make it harder for it to pay back so quickly. So maybe we give it a 10% discount rate. So year 0, no, no discounting at all. Year 1, let's give it a 10% discount rate. So let's adjust it for some risk. So saying it's risky, so we're not looking at 70 coming in year 1, we've adjusted it down to 64. Year 2, again at 10%, we're not expecting 140 this time, we've adjusted it down to 116 to try and build in some risk. Okay, so now using those figures, let's see, remember the first one, it was paid back, normal payback, we thought we'd be paid back in a year and 2.5 months. Well now for our investment appraisal, we're going to use a bit of risk, and we said, right, 100 coming in, going out, sorry, in year 0, year 1, 64 coming in, adjusted for risk, which means we need another 36 in order to get to the payback period. And that 36 will obviously come in year 2, because we have 116 coming in. But how quickly in year 2? Well, again, you take the 36, you divide it by what's coming in the following year, and this time you get 0.31. And 0.31 times 12 is 3.7 months. So it's actually, according to adjusted payback, will be paid back a year and 3.7 months. Simple payback suggested a year and 2.5 months. This one's longer because we've added in some risk. We've incorporated some risk. Okay, that's how it's done.